Wall Street is in a panic. Will Trump's trade war collapse the global economy? Investors are in dismay as U.S. stock markets rapidly lose ground for the second day in a row, like a house of cards collapsing under the pressure of escalating trade tensions between Washington and Beijing. After yesterday's dizzying 1,700-point drop, the Dow Jones Industrial Average lost another 1,000 points, sending shivers down the spines of even the most seasoned market players. Futures on U.S. stocks show every sign of an impending storm, signaling a massive retreat by investors. On Friday, April 4th, Beijing retaliated by imposing 34% tariffs on imports from the U.S., triggering a new wave of sell-offs in U.S. markets. This followed the U.S. announcement on April 2nd of duties to coincide with Independence Day, which led to a one-day Wall Street crash of $3.1 trillion. Just 12 hours before so-called Donald Trump Liberation Day, the president intends to announce sweeping global tariffs on goods imported into the United States, which could further exacerbate the situation. The simmering conflict between the world's two leading economic powers has flared up in recent days, escalating into an open trade war. Amid the sharp decline in U.S. stocks, the question of further escalation of this confrontation is being raised ever more loudly. China has repeatedly expressed dissatisfaction with the unilateral actions of the U.S. and the imposition of additional tariffs. The new round of tension began on April 2nd, when the Trump administration imposed duties affecting virtually all sectors and aimed primarily at China. The increase in tariffs, reaching 50% in some cases, forced Beijing to take retaliatory measures. The Chinese Ministry of Commerce, guided by the principle of reciprocity, announced the introduction of a 34% duty on imports from the United States. These events triggered another wave of declines on the U.S. stock market, dubbed the second bottom. Reputable publications such as CNN and The Washington Post ran headlines like, "U.S. stocks fall again, Wall Street experiences second scare." By the end of 2024, trade between China and the United States had reached an impressive $660 billion. At the same time, Chinese exports to the U.S. amounted to about $530 billion, while American goods shipped to China barely reached $130 billion. This disparity has caused a chronic trade deficit, which has drawn sharp criticism from Washington. U.S. authorities have expressed dissatisfaction with the fact that the Chinese market is literally flooding the U.S. with huge quantities of goods, while exports from the U.S. to China remain disproportionately low. In an attempt to somehow balance the situation, Washington imposed high tariffs on Chinese products. However, retaliatory measures from Beijing have created new obstacles for American goods. Now goods from the U.S. destined for the Chinese market, especially in key sectors such as agriculture, automotive, electronics, and machinery, face a colossal 34% tariff. Experts have long warned about the possible consequences of these retaliatory measures for the American economy. After all, the U.S. exports billions of dollars worth of agricultural products to China, including soybeans, meat, and corn. The introduction of increased import duties of 34% will inevitably push Chinese consumers to seek alternative suppliers, which threatens colossal losses for farms in the Midwest. The memory of the 2018 to 2019 trade conflict is still fresh, when American farmers, despite state support, faced the loss of sales markets. Today, the situation looks larger and potentially more devastating. The automotive industry is also under attack. Giants such as GM, Ford, and Tesla either export their products to China or depend on supplies of Chinese components. China's retaliatory measures in the form of increased taxes will hit the competitiveness of American models represented in the Chinese market. This process will trigger a chain reaction of negative consequences: rising prices, disruptions in the supply of raw materials and components, and narrowing export opportunities. As a result, American automobile concerns will face a drop in profitability, which may force them to resort to unpopular measures, such as reducing production volumes, laying off personnel, or raising prices for their products. The recent fall in Tesla's stock amid uncertainty in the Chinese market is exacerbated by the introduction of a 34% tax, creating additional difficulties for the company. A similar situation is observed in the electronics and high-tech sectors. Despite the United States' leading position in the production of semiconductors, software, and high-tech products, the Chinese market remains a key source of revenue for many American companies. The introduction of a 34% tariff creates serious obstacles for the supply of American products to China and also disrupts existing supply chains that depend on Chinese manufacturers. If Beijing takes additional measures restricting the activities of American companies in China, it could lead to serious disruptions in the global economy. The first signs of this instability already appeared on Wall Street between April 3rd and 4th, when a second wave of falling technology stocks reflected investor concerns about the rapidly deepening crisis. The question of how much the introduction of a 34% tariff will cost the American economy remains open. According to analysts, the initial reduction in trade volumes could amount to $40 to $50 billion. With China importing approximately $130 billion worth of goods from the U.S. annually, the introduction of 34% tariffs could push Chinese consumers to seek alternative suppliers. This could lead to even greater losses for American companies than initially anticipated. Moreover, if the logic of mutual restrictions inspires other countries, and major players such as the European Union or Canada follow suit, the share of American companies in the global market could significantly decrease. Such a scenario would inevitably affect Wall Street, triggering increased stock market volatility, pressure on corporate profits, and, as a result, a downward revision of economic growth forecasts. Uncertainty also looms over the situation of ordinary Americans. By Independence Day, consumers had already felt the rise in prices for goods dependent on imports. At the same time, China's retaliatory measures put American exporters in a difficult position. Farmers faced reduced incomes, the automotive industry was forced to revise production plans, and technology companies were cutting costs. Employment and wage levels are under threat. The United States of America risks facing the prospect of an economic downturn due to shrinking export markets, rising prices for imported goods, and increased inflationary pressure. According to experts, such a scenario does not bode well, as historical experience shows that large-scale protectionist measures have often led to similar consequences. In this situation, China is demonstrating a firm stance. If the U.S. policy is tightened, China does not intend to show restraint. Chinese media emphasize their readiness to respond symmetrically to any actions by the U.S., which implies the possibility of expanding the range of retaliatory measures beyond agriculture and the automotive industry. According to some reports, the Chinese government is developing large-scale stimulus packages aimed at mitigating external shocks by strengthening domestic consumption. In response to American tariffs, China may resort to more actively stimulating the economy and developing alternative trade ties. CNBC reports on the possibility of accelerating the reorientation of Chinese production, one of the largest in the world, to regions such as Europe, Southeast Asia, and Africa. It is emphasized that China does not intend to close its market, but trade relations with the U.S. are seen as increasingly risky. A trade war between the two largest economies in the world threatens to reshape global economic ties, leaving the U.S. isolated from the global network of supply and demand. Tensions between Washington and Beijing are causing concern worldwide. European media are sounding the alarm, predicting that the clash of the two giants will affect everyone. Asian stock markets are in turmoil, reacting to every move by the U.S. and China. Japan and South Korea are confusedly trying to determine their position in the new reality. At first glance, the conflict is unfolding between the U.S. and China, but in the context of global economic integration, all countries are drawn into a common chain. Beijing's retaliatory measures hit American companies with production in China, causing a domino effect that affects suppliers in Europe. From agricultural products to high technology, from oil trade to logistics, no one is left out. All market participants are frantically looking for new strategies. In the financial world, there is increasing talk of a second day for the U.S. stock market, which is not surprising given the news of mutual sanctions. Just 2 days ago, a wave of panic led to the evaporation of $3.1 trillion. The new round of tension caused by Beijing's decision to introduce 34% tariffs immediately triggered a wave of alarming forecasts. Amidst falling stock prices, there are increasing calls to prepare for the worst-case scenario in the near future. Technology corporations such as Apple and Microsoft, as well as automotive giants GM and Ford, are under particular pressure. The world appears to be only at the beginning of an unprecedented trade war, and if the current escalation continues for several months, the threat of recession will become very real. Analysts are unanimous in their warnings. Protectionist measures could exacerbate the problems of the global economy, and ultimately everyone will suffer. But what prompted China to take such drastic measures against the United States? Beijing has long expressed dissatisfaction with Washington's unilateral accusations, insisting that it offers diplomatic solutions to disputes concerning technology transfer, intellectual property protection, and the significant trade deficit. However, as the Trump administration stated on April 2nd, years of negotiations have yielded no results, paving the way for the construction of a full-scale tariff wall. In response to the increase in tariffs by the United States, China demonstrated unexpected resolve, abandoning moderate measures and sending a clear signal to the world about its unwavering position. This move not only exacerbates the economic confrontation between the two largest powers, but also forces other countries to choose sides in this conflict. Major players such as the European Union, Canada, and Mexico may be forced to impose their own tariffs against the United States or China to protect their economic interests. Trade between the United States and China, reaching $660 billion annually, is not just an impressive figure, but also a vital element of global production chains. This flow of goods and services sustains thousands of enterprises, hundreds of thousands of suppliers, and millions of workers worldwide. Now, with tariff barriers reaching 34%, their impact is felt at all levels of the global economy, from stock exchanges with trillions in turnover to farms, from large corporations to small artisans. The main question is whether this trade war will escalate into a protracted and deepening conflict, or whether the parties can find a path to compromise and return to the negotiating table. Uncertainty is the main enemy of market stability. Sums reaching billions of dollars, changing hands within a day, indicate that panic selling can not only continue but also spread like a tsunami to various sectors of the economy. The hardline chosen by China has already had a destabilizing effect on the United States stock market for the second time. Officials remind that China's retaliatory measures are quite legitimate, given that the American tariffs, presented as a triumph, faced resistance in the first week after their introduction. Given the significant share of the United States in China's foreign trade, the current situation may force American society to consider the feasibility of such high tariffs. In the event of a sharp rise in prices, increased inflation, and reduced production, it will be difficult for the White House to justify this policy. On the other hand, the Trump administration is sending a signal to its electorate about saving American industry, and retreating in the face of a powerful populist wave could have serious political consequences. In the escalating trade and economic confrontation, there will be no winners. Mutual losses are inevitable, experts warn, drawing parallels with the protectionist policies of the 1930s. Then, the construction of customs barriers only exacerbated the Great Depression. In the modern world, where globalization has reached unprecedented proportions, the collapse could have even more far-reaching consequences. The escalation of tension between the United States and China is fraught with a reduction in world trade, a downward revision of economic growth forecasts, a wave of corporate bankruptcies, and rising unemployment. If other countries, such as Mexico, Canada, and European states, resort to similar measures in an effort to protect their own interests, a general wave of protectionism could cause even greater damage to the global economy. The American stock market has already reacted sharply to China's actions, and further developments remain uncertain. In the near future, neither side seems willing to compromise on principles. Prolonging the conflict will result in the whole world being the loser. Companies will be forced to restructure logistics chains, which will require significant time and financial costs. The consumer market is preparing to face a wave of price increases, which will inevitably lead to a decrease in consumer activity. The agricultural and manufacturing sectors face the threat of layoffs, accompanied by a decline in employment rates. Stock markets, as if sensing impending changes, may once again plunge into chaotic turbulence. Experts suggest that the first bottom of the crisis has already been reached, but it is possible that several more are ahead, perhaps a third and fourth. A prolonged period of instability could drastically reshape the map of world trade. Consider the impressive trade volume between China and the United States, where key items include electronics, textiles, machinery, automobiles, agricultural products, and chemical industry outputs. The United States exports soybeans, meat products, automobiles, and aircraft to China, while importing semiconductors, consumer electronics, textiles, and machinery components. Now, both of these flows are burdened by a 34% tariff, creating an additional strain. The U.S., in its efforts to regulate imports, ultimately faces rising prices on store shelves. China, in turn, intends to protect domestic producers by making American imports less accessible. However, in the event of a cessation or reduction in supplies, it will have to seek alternative sources of raw materials and products. World trade stands on the threshold of a major transformation. While two economic giants, the U.S. and China, are engaged in a fierce battle for leadership, other countries may see this as an opportunity to strengthen their positions in the global market. A logical question arises: how painful will China's retaliatory measures, expressed in 34% tariffs, be for the U.S. economy? If American companies face falling profits and consumers feel rising prices, will this become a bitter reminder that Independence Day has turned into unpleasant consequences? In the event of a protracted conflict, the balance of world trade may undergo irreversible changes. In this chaotic confrontation, where each day brings new reports of retaliatory measures, stock market crashes, or glimmers of diplomatic hope, the global economy is undergoing a serious test of strength. The outcome of this trade war, like a shifting dimension, could have a profound impact on the entire global system, far beyond Beijing and Washington. It remains only to observe the unfolding events to understand who will emerge as the winner and who will suffer losses in this new reality.